What's up, guys? It's Sam here, and I wanted to talk a little bit more about options trading. With that being said, make sure you press that like button and subscribe if you're on YouTube, and if you're on Facebook, then go check out my page and press that thumbs up button or follow button. I gotta check that out so I can get the intro proper on these videos. Okay, so to give a little bit of context, I was homeschooled my entire life, and then I went to a 2-year school to save money, and then I went to a four-year school, right? And I studied finance and economics, and then I went straight into an MBA program and studied finance and accounting, and then I went. In conjunction with getting my MBA, I was also doing the CFA. If you have never heard of the CFA, think of it as like a CPA here in the United States. I'm not sure if CPA is around the world, but it stands for Certified Public Accountant. Think of that, which is a more commonly recognized name. And then if you think of that, and if you have some degree of like how anybody else has talked about that, or how somebody else has perceived the difficulty of that, and then multiply that times 2 or 3 in terms of more difficult, and that would be like the CFA. Covers a lot of accounting, a lot of finance, statistics, economics, and the ethical foundation of the financial markets. And so that's kind of given the ground. I've never worked in trading before, but that was when I was introduced to, it was an undergrad. It was one of my last classes in the last year for undergrad. And I was introduced to options at that time. And from that point on, they were just very, very intriguing to me. In grad school, I took a few classes on options. In the CFA, they have sections in each level on different types of derivatives. And options were always super intriguing to me. So with that being said, I've never actually traded them other than in demo accounts. Ameritrade has their Thinkorswim platform, and so I had created a demo account on there, and within 90 days I doubled it. But that's not representative, right? Like, that's not real fucking money. You're not necessarily going to take the same types of risks if it's your own money, and you're not necessarily going to trade the same. Anybody who actually does any trading knows that. So Robinhood comes out. Robinhood is a brokerage platform that's absolutely free. So if you have a brokerage platform, and if you do even a couple trades a year, first of all, I don't advocate anybody else do any fucking trading. I would say that you should just fucking invest as much as you can in a broad index, very cheap broad index fund, whether that's a mutual fund that is very low cost, or an ETF of some sort, just some type of index fund that is extremely low cost, that represents the market as a whole, and very, very, very little in bonds unless you are older or whatever. But I'm not giving any type of advice for anybody else. You do your own fucking shit. Now, with that being said, being a completely free platform, when you trade options, there's like 2 fees you have to pay. There's like I don't remember, the trading fee and the contract price, or something along those lines. Anyways, with not the contract price, something else. I don't remember what it was. But with Robinhood, it's absolutely free to trade options. So I put had about $1,500 in there. Actually, if you look at last week's video, you'll be able to tell exactly how much was in there. As of 3/10/2019, there was $1,444.85. And since then, there's more than that, but I would have to look that up at a different time. I will do an update actually on the balance in the account, probably in the next couple days or after Friday. So, because it's completely free, I sold a put, right? There's only $1,500 in there, so I don't have a tremendous amount of buying power. And with Robinhood, there's a limited functionality in terms of different strategies, like butterflies and iron condors and credits and debits in terms of different whether you're doing puts and calls and all that kind of stuff. It's limited in how you can do it in terms of like combining them to make a strategy and then executing it. You just have to do each individual leg of the options strategy. So since there's barely any capital in here, right, $1,500, you're kind of limited to the certain things that you can do. So I mean, I could put more capital in there, but I'm not going to do that at this point. I'm just going to keep testing to see how I can build the return on here. So and I have the order history up here just because I wanted to show you guys. On March 12th at 9:43 a.m., the order was filled to sell a options contract. So an option contract is based on 100 shares, and hopefully you can see this. Down here has the date when it was filled. It's for one options contract. So this is a put on Sirius XM. They're trading about $6 a share. And the put was for 6 when they were right about at the money. What that means is that the price of the stock was right at about $6. So $6 is the exercise price, as you can see right up there. So what that means is Siri, $6 put, sell, $3.15. So what that, as you can see right up there. So what that means is Siri is the Sirius XM. That's the ticker symbol. $6. That's the exercise price. So that's the price that you can exercise the option at if you're the holder of the option, if you purchase the option, because they have the ability to do that. I just have the obligation to fulfill my side of the contract. If any of this is super interesting, you should look up some other stuff on options because they're super intriguing and they're very, very, very interesting. Actually, I view a lot of the videos that I put out online as very low cost call options because they actually keep increasing in value the more content I put out. So it's an interesting way to look at it because, I don't know. Anyways, if you guys have comments about that, let me know down below in the comments. Okay, so and the sell means that I sold that contract to somebody who purchased it, right? And the 315 is the date of expiration. So there's weekly, there's monthly, there's even leap options, which are just longer term options, like I think over 12 months or something like that. And the price right here, so you'll see there's a quantity right there, and then there's a price of 10 cents. But as I mentioned a minute ago, the contract is based on 100 shares. So whatever the price is at 10 cents, you multiply that times 100 because it's based on 100 shares. So the actual contract price for the option is $10. So I sold it, right? So if I sell something that's worth $10, I get $10. So I get a $10 credit. Excuse me. The price of SiriusXM moved up slightly. So it's a put. So the holder of a put, like if you purchase that, how does the holder of a put make money if the price goes down? So I sold that. So I don't own it. The other person does. And they benefit if it goes down. The price went up. So who does that benefit? Me. So I closed out the position. I think it was today, around 9:30. So as you can see right there, 9:30, I closed out my position at $2. So it was 2 cents, but remember it's based on 100 shares, so that's $2. So I sold it for $10, and then I bought it back for $2, because that way you can close out the position. Maybe something, and there's different factors that go into option pricing. If you're interested in it, you should Google some of this shit. But one of the factors that happens in weeklies is there's a very rapid decline in the decay of the time value on these options, which benefits the seller. So as I mentioned, if the price goes down on a put and you're the holder, that's good for you. Now if you're the seller and the price goes down, that's bad for you, right? Like if the price of Sirius XM had gone down, and my, say if it went down below $6, right, and I had sold it, then that would be bad for me. So my position would be, could potentially be negative, right? But if you take the 10 cents minus $6, then you have the break even, because there's no cost for trading these options, so it's just a straight break even. So this actually allows you to have different break evens than if you were using Charles Schwab or a different trading platform, because there's no cost. So your break evens are actually at a lower point than they are at other platforms where you actually have to factor in the trading costs. So anyway, $6 minus 10 cents is $5.90. So that would be my break even. So if SiriusXM went from, whatever it was, like $5.98, and then went down to $5.91, even though it could potentially be negative, right? If it expired tomorrow at that price, I wouldn't lose anything. I would still just get the $10 from it. So because it's such a small balance, right? So if you took the $8 I made divided by so it would be like 0.5% on my entire portfolio in like 4 days. Now, that's cool and everything, but that's not. What will be more interesting is if I can earn 0.5% every week, or 1 or 2% every single week. That will be interesting to see consistently, and I will continue to put out this type of content to just show you what I'm doing and just document the journey of me playing with this as my account balance grows. If you guys have any questions, let me know down below in the comments. Appreciate you guys. Talk to you soon.